There is this really profound, almost mind-bending contradiction buried in the latest earnings report from one of the world's largest private owners of timberlands.
Oh, absolutely. It's fascinating.
Right. Because they are pulling in these staggering profits, but a huge portion of that windfall comes from getting paid an unbelievable amount of money to, well, deliberately not cut down their trees.
Yeah, which completely flips the century-old business model of forestry right on its head. I mean, when you sit down and analyze Weyerhaeuser's Q1 2026 earnings presentation, it really reads less like a standard corporate accounting document and more like a real-time barometer for the entire global economy.
Yeah, you're seeing the housing market, international supply chains, and this highly lucrative new reality of climate-based real estate deals all just colliding in a single 3-month window.
Exactly. It's all happening at once.
So welcome to today's deep dive. Our mission today is to look past the dense financial charts of Weyerhaeuser's Q1 report and really uncover the fascinating real-world mechanics driving those numbers.
Because there's a huge story there.
There really is.
Yeah.
We want to understand how a company whose entire legacy is built on, harvesting timber is suddenly finding immense value in leaving the forest completely alone. And what their supply chain tells us about the sheer cost of building a house today.
Well, the contrast between the end of last year and the beginning of this year is just stark. It's a massive spring thaw for them.
For sure. I mean, in the fourth quarter of 2025, Weyerhaeuser's Adjusted EBITDA, which is basically their cash profit from core operations, was sitting at $140 million.
Which was a really rough quarter for them.
Right, but then by the end of quarter one of 2026, they had more than doubled that figure, hitting $308 million in Adjusted EBITDA. Their net earnings reached $156 million on over $1.7 billion in net sales.
Yeah, and that kind of turnaround in just 90 days, I mean, that doesn't just happen by random luck.
No, you don't double your operating profit just because the sun came out. There has to be a structural catalyst. And if you look at the first page of their report, they initiated a really major corporate shakeup on day one of 2026.
They absolutely did. They took this rather boringly named division, I think it was Real Estate, Energy, and Natural Resources, and just overhauled it entirely. They rebranded it as Strategic Land Solutions, or SLS.
Right, SLS. But this reorganization, it goes way beyond just printing new letterheads, doesn't it?
Oh, yeah. The new SLS segment still handles the traditional real estate and natural resources stuff, but they carved out a brand new, highly official business line called Climate Solutions.
And what exactly does that cover?
This specific branch is dedicated to forest carbon, carbon capture and sequestration, and mitigation banking.
Okay, I have to pause here. Because whenever a legacy natural resource corporation suddenly leans really hard into, climate solutions on their investor calls, my immediate instinct is to flag it as greenwashing.
Sure, that's a totally fair reaction.
Right. It usually just looks like a PR move to appease environmentally conscious investors, while the core business basically ignores it. So, is there actual quantifiable revenue backing up this new division? Or is it just corporate fluff?
The financials give a very definitive answer on that. It's absolutely real money. The newly minted SLS segment generated $193 million in Adjusted EBITDA in Q1 alone.
Wow.
Yeah, and to put that in perspective, the predecessor segment only made $95 million in the previous quarter, so they practically doubled the profit of that entire division.
That is wild. And the primary engine for that massive quarter wasn't selling off parcels of land for luxury subdivisions or anything like that.
Not at all. It was a single $94 million conservation easement transaction in Florida, categorized squarely under that new Climate Solutions banner.
Wait, $94 million for a single conservation deal?
Yes, one single transaction.
If you are wondering how this actually functions in the real world, let's break down the mechanics a bit. Because a conservation easement means Weyerhaeuser still retains ownership of the land, right?
They still own the dirt.
But they sign this legally binding agreement that strips away their own rights to develop or commercially harvest that specific ecosystem. So they are essentially being compensated for the theoretical lost revenue of not turning that forest into 2x4s or, strip malls.
Exactly. And the funding for these massive deals usually comes through mechanisms like mitigation banking.
Can you explain how that works for us?
Sure. So, say a large infrastructure project, like a developer expanding a highway or building a huge commercial complex elsewhere in Florida, unavoidably destroys protected wetlands. Environmental regulations require them to offset that damage. They literally have to purchase conservation credits to make up for what they paved over.
I see.
So Weyerhaeuser steps in, points to their untouched acreage, and says, hey, we have these credits. The developers pay Weyerhaeuser tens of millions of dollars, and Weyerhaeuser locks their land into conservation perpetuity.
So they essentially monetize the absence of activity. The untouched ecosystem itself becomes the actual product.
Yeah, which validates the entire corporate restructuring. Climate Solutions is no longer just some fringe ESG initiative for them. It is a nearly $100 million primary revenue driver.
It really proves that leaving carbon in the ground, or, in the root systems and the tree trunks in this case, is becoming a highly tradable, institutional-grade commodity.
It really is. But to be fair, protecting a few strategic parcels in Florida doesn't change their fundamental identity overnight.
Right. Weyerhaeuser still holds millions of acres explicitly to chop them down and fell the wood.
Exactly. And that operational reality brings us to their traditional core, which is the timberlands segment.
So how did the actual farming of trees do this quarter?
It saw steady, if somewhat unspectacular, growth. In Q1 2026, the timberlands segment's Adjusted EBITDA ticked up to $120 million. That's a modest increase from $114 million in Q4.
Okay, steady. But the internal data here reveals a really fascinating dynamic about the limits of modern corporate logistics. This is honestly the part of the report that I found genuinely entertaining.
Oh, with the weather.
Yes. You have this publicly traded juggernaut utilizing satellite imaging, predictive supply chain algorithms, automated mills, all this high-tech stuff. Yet at the end of the day, their entire profit margin is fundamentally at the mercy of the skies.
Mother Nature is the ultimate CEO.
Exactly. It's like a high-tech farming operation. You can have the best logistics in the world, but if it rains too much in the south, your sophisticated data models are useless because the trucks literally get stuck in the mud.
Yeah, the regional breakdown illustrates that perfectly. In the west and north regions, they experienced unusually favorable weather conditions early in the quarter. The ground was solid, the weather was clear, so they saw higher fee harvest volumes.
Let's quickly clarify that term because fee harvest pops up constantly in these forestry reports.
Point.
It refers to trees harvested on land that Weyerhaeuser owns outright fee simple ownership. They aren't leasing the land or buying logs from third parties, so the margins on those specific trees are the absolute highest in their portfolio.
Correct. So favorable weather in the west and north meant they could maximize the harvest on their most profitable land.
But down south, it was a different story.
Right. Adverse weather early in the quarter created a major bottleneck. The heavy rain slowed down all the machinery, lowered their overall harvest volumes, and it actively drove up their forestry and road maintenance costs.
So the environment acts as the ultimate constraint on production. You just can't algorithm your way out of a swamp.
You really can't. But weather wasn't the only variable padding the timberlands balance sheet this quarter. They also reported a $58 million special item gained from a transaction on the East Coast.
Right, they sold off a specific parcel of timberlands in Virginia.
Yeah, which demonstrates their active portfolio management strategy. They don't just hold land statically. They are continuously evaluating their holdings, trying to identify areas where shedding specific assets provides a strategic capital injection without disrupting their long-term harvest pipeline.
And the destination of that harvest pipeline reveals a lot about their international leverage, too. Because when you look at their Western export log revenue, you realize they aren't just feeding domestic U.S. housing developments.
No, the global stage is huge for them.
Japan is absorbing an overwhelming 88% of their export log revenue from the West. And China accounts for roughly 10%.
Yeah, Japan has always been a premium market for high-quality logs. Their specific construction styles and very strict housing standards demand specific grades of timber, and Weyerhaeuser has clearly established a lock on that supply chain.
That has to provide a massive safety net.
It does. Maintaining that steady international demand provides a crucial anchor. It completely insulates their Western operations from the unpredictable boom and bust cycles of the U.S. domestic housing market.
Right. But once those trees are actually felled, the logs that do remain in North America transition into the manufacturing phase. They get loaded onto trucks and head to the mills, entering the wood products segment.
And honestly, reading the financial swing in this specific division induces vertigo.
The volatility is just staggering.
It really is.
I mean, in Q4 of 2025, the wood products segment posted a $20 million loss. They were bleeding cash. But then 3 months later, in Q1 of 2026, they reported a $71 million profit.
That is a $91 million turnaround.
Yeah. And the most surprising detail is that they didn't achieve this by dramatically increasing their output. Sales volumes for lumber were only slightly higher, and sales volumes for their engineered panels actually decreased.
Right. The actual volume of wood didn't change. The value of the wood did. The broader commodity pricing landscape just shifted entirely in their favor.
So what did those numbers look like?
Well, lumber sales realizations, which is the final actual price they receive per unit after all the market fluctuations settle, increased by 13%.
Which translates to an additional $65 per thousand board feet.
Exactly. And they also saw an 8% increase in OSB realizations.
And for anyone listening who isn't a contractor, OSB stands for Oriented Strand Board. It's basically those engineered wood panels made of compressed wood flakes that builders use to sheathe the outside walls and roofs of new houses.
Right, it's everywhere in construction. They also noted a $28 million product remediation insurance recovery.
Oh, what's that for?
The report mentions a Q4 benefit related to an early 2025 fire at an MDF facility, MDF being medium-density fiberboard, the smooth composite wood often used in cabinetry and furniture.
Okay, so there is some insurance math padding the Q1 profit.
There is, yeah. But the underlying engine of that massive $91 million swing is still purely the spike in commodity prices.
So if you are planning to build a deck this summer, or if you're looking at newly constructed homes, this explained exactly why your budget is suddenly stretched. A slight squeeze in the supply chain makes the lumber yard significantly more expensive.
It's a direct correlation.
But I want to really dig into the math here for a second. How does a seemingly modest bump of $65 per thousand board feet translate into tens of millions of dollars in actual corporate profit?
Well, Weyerhaeuser includes this really telling section in their report called sensitivity metrics. It maps out exactly how hyper-leveraged they are to these commodity fluctuations.
Right.
Because they produce at a continental scale, tiny price increments equal monumental sums of money. Based on their internal metrics, a mere $10 change in the price of OSB translates to roughly $30 million in annual EBITDA.
Wow.
And for lumber, a $10 change per thousand board feet equals roughly $50 million annually.
Hold on, let me just think about the mechanics of that. If a $10 bump translates to $50 million in annual profit, their operating expenses must be practically cemented in place.
That's exactly it.
Right. It costs them the exact same amount of money in labor, electricity, and mill maintenance to produce a piece of wood on Tuesday as it did on Monday. So when the market price of that wood goes up by $10, they have zero associated costs to subtract from it. Every single extra penny flows 100% to the bottom line.
That is the exact mechanism at play. Their fixed manufacturing costs create a fulcrum. They're basically a massive lever resting on U.S. housing demand.
Ah, I see.
When builders start buying and the available supply tightens even slightly, prices rise. Weyerhaeuser captures that expanded margin immediately. Conversely, when prices drop, those fixed costs remain, which is exactly why they saw a $20 million loss in the previous quarter. The leverage cuts both ways.
That makes perfect sense.
Yeah.
And knowing how extreme that leverage is naturally leads to questions about their capital strategy moving forward. After riding this wave of high commodity prices and closing that $94 million Florida deal, Weyerhaeuser finished Q1 sitting on $299 million in cash.
Which is a very comfortable position to be in.
For sure. But what is the actual protocol for deploying that kind of capital? Do they just sit on it?
No, their corporate philosophy heavily prioritizes the shareholder. They have a stated target of returning 75 to 80% of their adjusted funds available for distribution back to investors.
Okay, let's translate adjusted funds available for distribution, or adjusted FAD as they call it, into plain English. That metric represents the cold, hard cash left over after paying all the necessary bills, right?
Yeah.
It's the money remaining after they maintain the mills, fund the planting of new seedlings, cover basic administrative costs, and pay out their standard-based dividend.
Exactly. It is the true discretionary cash. And they funnel that 75 to 80% back through supplemental dividends and share repurchases.
Oh, right. During Q1 alone, they bought back $10 million of their own stock.
Yep. It is a highly disciplined framework. It's designed to guarantee that when the company hits a lucrative streak, the investors see the direct benefit rather than the executives just hoarding the cash for, unnecessary acquisitions.
Which investors obviously love.
Okay.
But looking ahead to the horizon, to their projections for the second quarter of 2026, the forecast gets decidedly murky.
It does drop off a bit.
Yeah, they expect timberlands and wood products to perform roughly in line with Q1, assuming lumber prices don't crater.
Yeah.
But their projections for the new Strategic Land Solutions segment show a really steep cliff.
They do.
They are forecasting Adjusted EBITDA for SLS to drop by about $70 million compared to Q1. Why are they anticipating such a severe contraction in their newest, most celebrated division?
Well, the drop actually makes perfect sense when you factor in the nature of the deals they are making. That $94 million conservation easement in Florida was episodic.
Meaning a one-off.
Exactly. You cannot sell a conservation easement on the exact same piece of land twice. Without another singular, monumental transaction lined up for Q2, the climate solutions numbers naturally regress to a lower baseline.
It really highlights the inherent lumpiness of real estate and mitigation banking.
Yeah.
They aren't churning out a steady, predictable volume of 2x4s every single day here.
No, they are hunting for complex, high-value deals that take months or even years to negotiate and close all at once.
Right. But even with that anticipated Q2 drop, the company's internal confidence seems to remain really high.
Oh, absolutely. They are still forecasting $425 million in Adjusted EBITDA for the full year 2026 for the SLS segment alone.
So they clearly believe their pipeline of future real estate and carbon capture deals is robust enough to carry them through the next 12 months, even if the quarter-to-quarter comparisons look a little turbulent.
Yeah, the Florida deal proves the concept is viable on a grand scale.
So why should you care about the quarterly earnings of a timber company, especially if your portfolio doesn't contain a single share of Weyerhaeuser stock?
Because this company functions as an incredibly accurate crystal ball for the physical economy.
Precisely. Their export reliance on Japan tells us about the stability of trans-Pacific trade. Their fixed cost leverage in the wood product segment tells us precisely why building a home in America currently strains the budget.
Right. And their newly rebranded Strategic Land Solutions segment proves, in real time, the immense financial value of environmental protection.
We are literally observing a legacy resource extraction enterprise successfully adapt to a global market, where leaving a forest intact is becoming just as profitable as feeding it into a sawmill.
It's a huge shift.
So to briefly summarize today's findings, we tracked Weyerhaeuser through an exceptional Q1 turnaround. They navigated out of a sluggish Q4 and posted substantial profits, propelled by a timely surge in commodity lumber prices and a highly lucrative strategic pivot toward climate-based land conservation in Florida.
And they are flush with cash, heavily returning it to shareholders, and bracing for a softer Q2 simply because, well, you cannot finalize a $94 million easement every single month.
Right. They managed the seasonal transition effectively, but their own sensitivity metrics highlight that they remain entirely tethered to the broader macroeconomic winds of housing demand and the unpredictable realities of regional weather patterns.
Yeah, Mother Nature and the housing market are still in charge.
Which leaves us with a final thought to consider. We began this deep dive by discussing how looking closely at rigid financial numbers can reveal a living, breathing landscape. In Q1, Weyerhaeuser proved that a corporation can generate nearly $100 million by explicitly binding their own hands and agreeing not to harvest a forest.
It's a powerful precedent.
It is. So as the global push for carbon capture accelerates and regulatory offset requirements become stricter everywhere, how far off is the day when a forest's absolute highest economic value isn't found in plywood and structural beams, but simply in existing?
That's a great question.
When does the math shift so completely that the most profitable action a timber company can take is to let the trees stand? It is something to mull over the next time you walk through the woods or the next time you look at the price tag in the lumber aisle. Thanks for joining us on this deep dive.